Hello traders, you are welcome back to the Forex Geek channel. In this video, we are going to be looking at one of the cleanest and most underrated trend tracking tools in technical analysis, and that is the GMMA, also known as the Guppy Multiple Moving Average. All right, so we're going to add the Guppy Multiple Moving Average to the chart right away. So if you've ever found yourself getting chopped up in sideways markets or entering trends too late, this strategy might be exactly what you need. So now, what is the GMMA? The Guppy Multiple Moving Average is a collection of multiple exponential moving averages, as you can see, split into two groups, the short term and the long term. All right, so the short term group reflects the behavior of traders, while the long term groups represent investor sentiment. Can you see? These are the trader EMAs 1 to 6. These are the investor EMAs 1 to 6. All right. Okay. And then you can see that there are also buy signals, the buy swing arrow up and down, the sell swing arrow up and down, the buy break arrow up and down, and the sell break arrow up and down. Okay. So now, the short-term EMAs, you can see, the short-term EMAs usually 3, 5, 8, 10, 12, and 15 periods. They track the immediate reaction of the market. They track the immediate reaction of the market. You can see the 3, 5, 8, 10, and 12, and 15. They track the immediate reaction of the market. These are the fast lines that respond quickly to price changes. Then the long-term EMA is typically 30, 35, 40, 45, 50, and 60, move slower and reflect long-term interest. When the short-term group crosses above the long-term group and begins to expand or fan out, that's a sign of trend strength. Conversely, when the two groups start to compress or cross over, it signals trend exhaustion or the beginning of consolidation. Let's just break it down further. The first step is setting it up. Obviously, you add the GMMA on your chart. Most trading platforms like TradingView will allow you to overlay multiple EMAs. If you're using the MetaTrader platform, you can search for this indicator as a custom indicator, download it and add it to your indicators library. All right. Okay. Now, once the indicator is on your chart, just observe the behavior between the two groups. If the short-term EMAs, which are the blue EMAs, if they cross above and begin to separate, if they cross above the long-term EMAs and begin separating from the long-term group, trend continuation is likely. All right. If the EMAs are compressing, you can see like what's happening here. It would signal a range or potential reversal. In this particular case, it was a range that we had. You can see we had a range taking place around here. So this gives you an early signal to enter or stay in a trade, unlike single moving averages that often lag behind. Now for entries, you should look for a clear breakout with the short-term EMAs crossing and fanning out above the long-term ones. So when you have the short-term EMAs cross above the long-term ones and start fanning out, that's a sign to enter a buy trade. All right. You wait for pullback to the short-term EMAs. Wait for price to pull back to the short-term EMAs, and then you get a confirmation via price action, such as a bullish engulfing, like what we can see happen here. You can see, I think this was even a morning star. So whatever bullish candlestick pattern that you find, this was a morning star. Whatever bullish candlestick pattern you find to verify that continuation, then you can enter your buy trade. The stop loss will be below the nearest swing low. Take profit can be at key resistance zones. Then the reverse is the case for a sell. You wait for the short-term EMAs to cross below the long-term EMAs and start fanning out. Then you wait for a pullback and you wait for a bearish confirmation candle, like a bearish engulfing, like what we had around here. Then your stop loss can be above the swing high, and take profit can be around the key support zones that you can find, okay, near swing lows, right? The nearest swing lows, okay. Now you should also be watching for the short-term EMAs flattening or crossing back under the long-term group. That could also be a sign to tighten your stops. Maybe if you notice that the short-term EMAs have begun to flatten and you are still in a trade, you can just tighten your stop loss or break even, or you can even start trailing your stop. All right, that's if you do not want to use predetermined take profit levels. All right. Now, unlike other indicators, the GMMA gives you a visual representation of market momentum and psychology. It filters out market noise, keeps you on the right side of the trend, and helps you avoid false breakouts. If you combine this strategy with solid risk management and discipline, it becomes a powerful addition to your trading arsenal. So that is it for this breakdown of the GMMA strategy. Let me know in the comments if you have used this indicator before, or if you plan to add it to your strategy lineup. When you are trading, ensure you always have good risk to reward ratios, minimum of 1:2, all right, for good risk management practices, and make sure that you do not risk more than you can afford to lose. Also, do not risk more than 2% of your account balance in a single trade. And hey, if you found this video helpful, make sure you smash the like button, subscribe to the channel, and turn on that notification bell so you do not miss out on more in-depth breakdowns like this. In the meantime, thank you for watching, and I look forward to seeing you in the next video. Happy trading.